Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at ProPhase Labs.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. Analyzing this company is, it's really a study in extremes. You have a business that is financially distressed right now, running on fumes.
Right.
But at the same time, it owns an asset that could fundamentally change cancer diagnostics. We have to start with the harsh reality, though. The current picture is pretty dire.
That's the classic high-risk, high-reward framing. But yeah, let's not sugarcoat that risk part.
Yeah.
What did the third quarter, the one ending September 30, 2025, actually tell us about the health of the operation?
It showed a significant contraction. Net revenue for Q3, it plummeted to only $0.9 million.
Wow.
Yeah, and that's down substantially from $1.4 million in the same period last year. And here's a really critical detail. They generated zero revenue from diagnostic services in that quarter.
Zero.
That means the shift away from their old high-volume COVID testing business has left this massive revenue void. And their current operations just haven't filled it yet.
So sales dropped off a cliff, but the costs didn't just disappear, which, inevitably leads to a major blow to profitability.
Absolutely. The net loss wasn't just substantial, it ballooned. They reported a net loss of $6.8 million.
Okay.
Or 16 cents per share. But just focusing on the income statement, that really misses the true danger that's lurking in the balance sheet. This is where the red flags, they start to turn into sirens.
Tell us about the balance sheet, because that's what determines survival when you're in a situation like this, a turnaround.
Well, the cash position is critically low. It's sitting at just $405,000.
That is a microscopic amount of cash to run a business like this.
It is. And even more alarming is the working capital deficit, which stands at a staggering $47.5 million.
A deficit that large, that's not just about having debt. It means your immediate short-term liabilities, what you owe right now, are $47.5 million greater than the assets you could sell quickly to cover them. That just screams a lack of liquidity.
Precisely. That massive deficit is really the lingering ghost of the old COVID testing operations. When they wound those down, they were left with these enormous operational liabilities, outstanding bills that have to be resolved.
So they're walking a tightrope.
It means the company is currently functioning in a financial tightrope walk, yeah. They're forced to prioritize their strategic initiatives above everything else because they just don't have the runway otherwise.
And the mathematical indicators, they back this up pretty forcefully. If we look at the margins, operating margin is negative 900%. Net margin is negative 12,241%. They're just storing capital.
It's an unsustainable rate.
But the most chilling metric for investors, I think, for gauging that immediate risk, has to be the Altman Z-score. What does a score of negative 4.07 signal to you?
The Altman Z-score, it's a formula that's designed to predict the probability of bankruptcy. And a score below 1.8 puts you in what they call the distress zone.
And they're at negative 4.
At negative 4.07, this isn't just distress. It signals that the company's underlying financial mechanics are, for lack of a better word, broken. It's a mathematical confirmation that, without a radical change, the current business model is completely unsustainable.
So that is the picture of risk. But we know the company isn't just sitting still. They're diversified diagnostics, genomics, consumer products. The strategy is to pivot, and pivot hard, to those high-value assets.
Right. They're a specialty health sciences company. The consumer part handles, OTC healthcare and supplements, and that gives them some minimal base revenue. The genomics division, Nebula Genomics, that's been stabilized. But the true focus, the massive lever for value here, is the new specialized diagnostics unit developing the BE Smart esophageal cancer test. The lack of diagnostic revenue in Q3, that was them stopping the old stuff to focus entirely on this new high-value test.
Okay, let's talk about that. The game changer, the transformational catalyst. Tell us what the BE Smart test actually is and why, despite all this financial carnage we just laid out, investors are still paying attention to this company.
So BE Smart is a highly sophisticated mass spectrometry-based assay. It looks at 8 specific protein biomarkers to perform risk stratification for patients who have Barrett's esophagus.
Right. And for anyone listening, Barrett's esophagus is a condition where the lining of your esophagus changes, usually from acid reflux, and it's a known precursor to a really aggressive form of cancer.
Exactly, esophageal adenocarcinoma.
So the test isn't diagnosing cancer directly.
Yeah.
It's telling you who among the population with that precancerous condition is most likely to actually get the deadly cancer. That is high-stakes predictive medicine.
That's it. And the clinical data that supports this risk stratification it's truly exceptional. The pivotal study that validated the test was just accepted for publication in Clinical Gastroenterology and Hepatology. It's one of the top journals in the field.
And that peer review gives it immense credibility.
It does.
And the data itself, we heard about 100% sensitivity. In layman's terms, why is that number so powerful? And are there any caveats?
100% sensitivity in a blinded study identifying patients who later got cancer, it means that in that group, the test produced 0 false negatives. If someone in that cohort was going to develop cancer, the test flagged them every single time.
Wow.
In cancer diagnostics, that's the holy grail of prediction. It means you don't miss patients who need intervention.
But the clinical world is always concerned with both sensitivity and specificity, right? If you cast too wide a net, you might catch all the true positives, but you also end up with a lot of false alarms, which leads to unnecessary, costly procedures.
That's the critical balance. And while the high sensitivity ensures safety, the test is also designed to be highly specific. But beyond just the predictive power, BE Smart has a huge logistical advantage.
Which is?
It requires only 1/10 the tissue sample size compared to the older legacy assays. That means less invasive procedures, and it's compatible with the standard pathology samples that are already being collected. It's designed to slide right into current clinical practice.
The clinical promise is clear. So let's quantify the financial opportunity tied to this. What is the total addressable market that management is projecting?
Management estimates the TAM to be somewhere between $7 and $14 billion annually.
7 to 14 billion.
Yes, and that market size comes from the roughly 7 million upper endoscopies done each year in the U.S. for things like GAA surveillance and Barrett's monitoring. And just for context, the company's market cap right now is under $10 million.
That puts the potential revenue opportunity at, hundreds, maybe over 1,000 times its current market cap. That disparity perfectly illustrates the high reward side of this whole equation. But a fantastic test that saves lives is worthless if the company runs out of money before it can launch. When do they expect to start bringing this online?
The plan is for a phased rollout starting in early 2026. Right now, they're in the regulatory prep phase and scaling up their lab capacity. And crucially, that Mayo Clinic validation study has attracted a lot of industry attention.
As people are knocking on the door.
The company has received multiple partnership inquiries. They are actively looking for a strategic path, maybe a partnership, maybe a licensing deal to accelerate the launch and, critically, to bring in capital.
Which brings us right back to the financial crisis. How do you fund a multi-billion-dollar opportunity with only $405,000 in the bank and a $47.5 million working capital deficit? The market has to be assuming massive shareholder dilution is coming.
This is the second pillar of their turnaround strategy, and it's arguably the most important catalyst in the near term. It's called the Crown Medical Collections Initiative. Management is going after the recovery of over $50 million in unpaid COVID-19 claims.
So these are just sitting as accounts receivable.
Exactly.
So this is basically a legal war against insurance carriers who used their labs but never fully paid the bill.
It is a high-stakes legal maneuver. And to speed things up, they've strategically filed Chapter 11 reorganization for the old COVID-19 lab units. This is not the parent company filing for bankruptcy. It's a legal tool to force the litigation and collection process forward and fast.
That is a clever, if pretty aggressive, use of the bankruptcy code. So the $50 million goal isn't just about cash, it's about non-dilutive capital. Money they can get without issuing a single new share.
Exactly. If they collect even half of that, say $25 million, that would solve the immediate working capital deficit, it would provide a comfortable runway, and it would fully fund the BE Smart commercialization without ever needing to tap the capital markets.
So success in this one area, this litigation, could single-handedly remove the threat of imminent financial collapse.
It could.
Okay, so we have the huge future upside from BE Smart and the near-term capital lifeline from the collections. What about the other parts of the business?
The genomics subsidiary, Nebula Genomics, has gone through a lot of restructuring. Management reports that it is now profitable on a pro forma basis.
That's a good sign.
It's small, but it helps stabilize the overall structure, and it proves they can successfully turn around a business unit that wasn't performing.
And beyond stabilizing their own operations, we've heard some pretty interesting strategic signaling from them. They've hinted at M&A discussions that could unlock value at multiples of the current share price. I mean, that's a bold statement for a company trading near its 52-week low.
It is bold. It suggests they are either in talks to sell a key asset, maybe Nebula, maybe licensing rights to BE Smart, or maybe they're planning something like a reverse merger. The message is clear. Management believes the parts are worth far more than the whole.
And they're trying to force the market to see that.
Exactly.
And then there's the unconventional piece of the puzzle, the crypto treasury strategy. After shareholders approved more authorized shares, they're still exploring this. In the biotech world, a crypto treasury, it just feels like a wild card, doesn't it?
It certainly adds a layer of complexity and
Yeah.
risk, but it does underscore the unconventional mindset of the management team. They're looking at every possible avenue, even non-traditional ones, to shore up that balance sheet.
Let's pivot now to what the public market is telling us. This stock is near its 52-week low of 16 cents. It's dropped over 72% this year. That just screams market skepticism.
Absolutely. A market cap of roughly $9.6 million for a company with a, $7 to $14 billion market opportunity. That speaks volumes about the perceived risk.
Right.
However, there is a fascinating counter indicator here. It's the price-to-book ratio, which sits very low, between 0.83 and 0.94.
And when a company trades below a PB of 1, it suggests the market is valuing the entire enterprise for less than the liquidation value of its net assets.
Correct. It means the tangible assets on the balance sheet, especially if you include that $50 million in accounts receivable, are technically worth more than the current share price. This is what attracts value investors who think those assets can be monetized. It flags the stock as potentially cheap if the turnaround works.
What about the other side of the bet? Investors betting against them. If this is such a distressed story, shouldn't short interest be through the roof?
Surprisingly, no. The short interest is minuscule. It's sitting at only 0.24% of the float.
That's nothing.
And what's really significant is that short interest has recently decreased by over 63%. This implies that the people who were betting against the company are actually pulling back. They're closing their shorts.
So they think the risk of being wrong is now too high.
It suggests they believe the collection efforts or the BE Smart launch might actually succeed.
Finally, what about ownership? Institutional versus insider.
Well, institutional ownership is low, around 9%, which is pretty typical for a distressed microcap. But the insider stake, that's more telling.
And what's that at?
Insider ownership ranges up to nearly 22%. When management and the people closest to the operations hold such a substantial stake, it signals alignment. They are literally putting their money where their mouths are. It shows a strong belief that their own strategies will work.
Okay, so let's try to sum this all up.
So in summary, we are looking at one of the most extreme risk-reward bets in the health sciences space right now. The company is facing a mathematical certainty of financial distress. We see it in the balance sheet. That is the hurdle.
But the prize is multifaceted. You've got a revolutionary validated cancer diagnostic with a potential multi-billion-dollar market. And you've got a clear, aggressive strategy to generate over $50 million in non-dilutive capital to pay for it all. Success in just one of those areas could instantly change the narrative.
Exactly. It would go from bankruptcy risk to massive growth potential. It's a binary situation where one successful strategic play really dictates the outcome. The next few quarters, focused on those collections and the regulatory progress, they're going to be the most critical in the company's entire history. Remember to stay informed on these critical developments by subscribing and leaving a comment below if you want us to analyze another stock for you soon.